Take a look at futures this morning. As you can see, the Dow is higher by 34 points, but the S&P and the Nasdaq are pointing to a lower open. Nasdaq in particular pointing lower by 32 points. We'll see how things go just an hour from now when the bells ring. But Nvidia is the stock of the day, the morning. Despite reporting a double beat last night, the stock is actually down about 1.25%, just over that. The world's most valuable company capitalizing on strong demand for AI computing power, but its data center revenue missed Wall Street expectations, not by a lot, but still it was a miss. But analysts brushed off the miss and they turned even more bullish, raising price target averages now to $235 on average. Also, second quarter revenue jumped 56% despite zero sales of the H20 chip to China. Nvidia is forecasting $54 billion in revenue next quarter while removing China data center revenue from the outlook. Let's bring in Laffer Tengler Investment CEO and Chief Investment Officer Nancy Tangler. Nancy, what did you make of the quarter?
I mean, honestly, Cheryl, I thought it was a great quarter. I think what the street or the algorithms, which trade after hours, are focused on is that the company guided to $54 billion, but the whisper number was 55. However, the $54 billion did not include China. The whisper number does. So when you back out China from the whisper number, they actually beat on that, and they certainly came in higher than the street. So I think this company is firing on all cylinders right now, and we do need to see what happens with China. But if you look at the valuation, Cheryl, I mean, the company is expected to grow earnings 131% in fiscal year 25, 26% in fiscal year, 50% in 26, and it's trading at a price earnings to growth ratio less than 1. I defy you to find another company with that growth profile that's trading at that discount.
Yeah, Mark Tepper, jump in here. I mean, again, Jensen Huang, the CEO, saying that the prediction here is that the largest AI companies, and this is just to be clear, this is OpenAI, Microsoft, Alphabet, are expected to spend $3 to $4 trillion over the next 5 years. That is a lot of money.
And I believe it because, when you think about AI spend, if you are a business and you are not spending on AI at any point in time because your business slows down, we're in an economic recession at that point in time, whatever it may be, whatever the reason is, you are going to fall behind. Your competitors are going to eat your lunch. So I think $3 to $4 trillion, I think that's very, very realistic. Nancy, question for you, though. I agree with you that I think Nvidia had a very solid quarter, and I think we dodged a bullet because my take is that if they did not have a solid quarter, I think this could have had a nasty ripple effect through all AI stocks, and you may have seen a 10% correction across the board in the AI space. What are your thoughts on that?
Yeah, I think you're right, Mark. I mean, if you looked at the futures when they reported, the NASDAQ was down over 100 points, and it's come back quite nicely. But I think one of the things that many people are not accounting for is in the One Big Beautiful Bill, there are three things that are going to benefit particularly tech companies: 100% bonus depreciation, deductibility of interest expense, and then upfront expensing of R&D. That is going to improve cash on the balance sheet by about over $50 billion for the hyperscalers. So there are a lot of tailwinds. Back out tariffs, which we've been in the camp that we think ultimately they may be deflationary, but back out tariffs, the positive benefits to earnings growth and margin improvement are going to continue in the second half of the year. And if we have a pretty slow growing economy, which we do, I mean, it's not disastrous, but it's not super compelling. Average the first 2 quarters, it's somewhere between 1.5%, maybe 1.75%. But if you look at where you want to be in that environment, it's the reliable earnings growers. We're in the early innings of this spend on CapEx. And I think it's going to continue. The $3 to $4 trillion is by the end of the decade. That's a lot of billions between now and the end of the decade.
Yes, certainly, Nancy. And again, the stock, Mark said this earlier, it could close up today when all is said and done.
I think so, too.
Yeah. Let's take a look at yields this morning, because we're about less than 2 minutes away from the second read of second quarter GDP. And economists are projecting a 3.1% increase, driven by strong consumer spending and steady business investment. Also, we're going to get July PCE tomorrow. Economists are looking for a monthly rise of 0.2%, 2.6% year over year. What do you make of these two pieces of data that we're going to get, Nancy?
Yeah, well, I think the GDP number is healthy, certainly, but remember, net imports dramatically impacted GDP in the first quarter, negative 4.2%, and they impacted positively in the second quarter. And remember, everybody was pulling forward demand in the first quarter to avoid tariffs. So I think if we get a number around 3%, GDP now is talking about third quarter GDP. I'm sorry, Atlanta Fed now is talking about third quarter GDP of
Wait, no,
plus
I got you.
plus 2%. So I think we're in great shape, and this is long before we get the benefits of the One Big Beautiful Bill Act.
Okay. So you're bullish.
And then on inflation, Cheryl, I think we're good on inflation.
So you're not worried about the PCE price index tomorrow, because that's obviously what the Fed's going to be looking at, and all eyes are on them for that September rate cut.
Yeah, no, I'm not. I mean, I've talked to you a lot about the 90s. We had 3% inflation in the 90s, and it coexisted quite and 5% on the Fed funds rate. It coexisted quite nicely with robust stock price performance because the economic growth was driven by productivity. I think that's where we are again now. Is inflation too high? Yes. But is it disastrous? No. And I think the Fed would be wise to look forward instead of backward.
Mark Tepper, what about you? What are you expecting?
On the GDP number?
Yeah, and on PC.
Well, GDP just came in at 3.3%, which beat the 3.1 that we were expecting. So that was a good read.
Your computer's working this morning.
Yeah.
No, I see it.
Look, PCE, I mean, we've really seen no issues with CPI. We saw the pop in PPI last month. So I'm not expecting anything different out of PCE. In my opinion, inflation, it's to Nancy's point, it's higher than where we'd like it to be, but it's moderated, right? I think it's well controlled. We need to ensure that the Fed is now focusing on the employment mandate. We need to ensure that the economy is growing. One of the best ways for the economy to grow is to make capital more affordable for business owners so that they can use that to hire more people, pay their current people higher wages. All those things are great for the economy.
All right, Mark Tepper, after my job this morning, I see how this works. Yep, first read of GDP. This is the first revision of second quarter GDP, and again, Mark just hit it, but it did come in better than expected, 3.3%. The street was looking for 3.1%, and again, this is higher than that initial read we got of 3%. And real quick, we did get jobless claims that came in kind of in line here, 229,000 jobs. The estimate was 230,000, and as far as the continuing claims as well, that coming in pretty much in line as well. So the continuing claims 1.954 million, just slightly below the expectations. Nancy, it's always great to have you on the show. Thank you so much for being here. And real quick, better than expected on this second read. It's pretty good.
Yeah, no, it is. I think we're humming, and we're about to start humming a little faster and a little more dramatically.
Right,
so
there you go. All right, Nancy Tangler, thank you for being here.